And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Well, again, the same stocks are driving the entire market. 12 stocks, 4 of those stocks, they are manufacturing the chip machines. And then, of course, you got 8 companies like, Microsoft and the rest of them are buying those machines so they can make chips. And it's the same companies every day that's driving this market. But what's interesting is we got the numbers today, and they're telling us how great the economy's doing, right? It's just not true. And what people don't see is coming is that right now, if you look at stagflation, I mean, that could hit us pretty hard, and nobody's even talking about it. So we got the same 12 stocks driving the market. We have inflation is reaccelerating. Nobody wants to talk about that. And take the CPI, year over year, we're at 3.8%. PPI, 6%. Gasoline up 28% year over year. Food, 3%. Rent, 3%. And people, well, wages are better. No, they're not. No. There's more people who are working terrible jobs than good paying jobs. Most of the jobs are part-time jobs. Remember, we just unloaded 100,000 full-time jobs, replaced them with 100,000 part-time jobs, and we just added another 100,000 multiple jobs. So more and more people are working 2 jobs. So play that cut, the first cut. Yeah.
We've never had people in a more gambling mood than now, but that doesn't mean that investing is terrible. It does mean that prices for an awful lot of things will look very silly.
Yeah, and what we're seeing is the durable goods. When you look at durable goods and they're negative, we're not selling durable goods. You're not selling TVs. You're not selling the large items because people just can't afford them. So when you see durable goods orders negative, that's really bad. That's really bad. So again, what we're seeing a lot of right now is they'll tell us how great the numbers are, but they don't tell you the truth that what's happening is we are selling less units, but the sales are going up. Not that more people are coming in to buy a bicycle. What's basically happening is if you're a store and you sold 1 month 100 bicycles, and let's say it was $4,000, the next month you sell, let's say $5,000 worth of bicycles. You think you're doing good, but you look and you sold, let's say, 100 bicycles less. Remember, it's always units. You got to talk about units. But when the government does numbers, they never talk about units. They don't want you to know about that. They don't want you to know the units. So again, when we have our CPI up 3.8% and PPI, which is your wholesale, 6%, and gasoline's the killer. I mean, 28%. So stagflation, and most people don't realize what stagflation is, and it can be miserable because once you get caught in stagflation, you can't get out of it. Inflation, you can work your way out. Stagflation, you can. Last time we got in stagflation, we were stuck for 10 years. Do you believe that? 10 years we were stuck. So it's when prices keep on going up, while the economy keeps slowing down, and that's what we have right now. Our economy's slowing, and then when you hear what the hell is his name? Payne talks about how the economy was sizzling. That's just not true. So the only place we are making money in the stock market right now, and been doing well since 2022, is in our, again, the same stocks, the same tech stocks. There's 12 of them. And that's the only thing. And the terrible thing about that is we got a very, very, very narrow market. And that's really dangerous. So going back to stagflation now, again, when prices keep on going up like they are, and the economy is slowing like it is, and that happens when oil goes up. And that's what's happening to us right now. Oil's back up over 100 again. And this war is not going to stop. This war is going to get worse before it gets better. And so oil is going to jump. Inflation stays hot. And growth just cools right off. And the Fed keeps on, they won't cut interest rates. They keep the interest rates high because inflation's high. So when you have that formula, you're going into stagflation. And the consumer really gets squeezed, and companies' profits go down, their earnings go down. But nobody's from Wall Street's going to talk about this stuff. They don't want you to know about it. All they do is party every day over the same 12 stocks. 12 out of 5,000 stocks, or if you want to be realistic, 12 out of 700 stocks. Unbelievable. So stagflation, you trade what benefits from high prices, essentially, like energy and commodities, and you're short what gets you want to be short what gets crushed. Okay, when growth slows, like small caps, we're going to just keep shorting the small caps. And right now we started to short the banks early, and we've been doing good with our banks. We just started to short them a few days ago, and I told my members, look, we got to start shorting these banks, because these banks are really going to get trashed, and especially if we get into stagflation. And we've been doing good so far with these banks. You should take a look at them. And so again, everything depends on a strong consumer, and we don't have a strong consumer. Even though play another cut where they tell us how strong the consumer is. It's insane.
We think the labor market's in much better shape than most people give it credit for.
I'm not going to give any credit. Why would I give credit? The labor market sucks. I mean, when you get another 100 multiple jobs, 100,000 multiple jobs, are you kidding me? You're doubling your multiple jobs, and you're doubling your part-time jobs, and your full-time jobs with good pay and good benefits are going down by 100,000? Come on, start telling the truth. So that's one of the problems that we're having right now. And so I would just say stagflation, just be aware of it, and you can make good money in a market when there's stagflation. If you know how to, as they say, if you know how to sell short, but you got to learn how to sell short to take advantage of it. So that's what's going on there. And the other thing that is that people aren't thinking about is in 1974, okay, in 1974, 1982, 1991, 2001, the economy, we used to always rebuild after corrections or crashes. And we do it by business investment. We didn't do that in 2008. We didn't do that in 2008. So we're in a real bad spot right now, because what we did, instead of rebuilding the economy by investing in machinery and equipment, and when you do that, that's where you create a good work base and you get jobs. But no money was put into business investment. They didn't want to do that. And one of the reasons they couldn't do it is because the banks were destroyed pretty much in 2008. This is when they started QE. And so everybody looked at QE for the next 14 years. Wow, look at it, isn't this great? No. It's going to smack us right into stagflation. It's not great at all. And now we're going to start hitting it. And that's the problem. Stagflation is going to be a result of that. When we had that 2008 crash, guess what? We just like 74 and 82 and 91. If you just go in and decide, well, we'll just keep on printing money, and we'll keep buying treasuries, and we'll keep cutting rates, and we'll just keep on printing and printing and printing and printing, take that money, buy treasuries, yields go down, and we'll keep pushing up the same dozen stocks. I mean, that is just absolutely ridiculous. So now you think about the number of all-time new highs we've had since 2022 to 2026. We've had in the spiders 120. We've had in the NASDAQ 100. We've had in the XLK, which is tech, pure tech, 100. I mean, and this is all from the same 12 stocks. 12 stocks are giving us that. I mean, this is just crazy. So you got, as I said, you got the same chip machine makers, AMAT, ASML, and LRCX and CLAC, and then you got 8, you know what they are, you know, Micron Technology, NVIDIA, AMD, you know them all, Broadcom. So what you got to do is you got to keep buying these stocks and make sure when you're buying them, don't catch them on the new highs. You got to let these stocks pull back. So if a stock went from 80 to 90, don't buy it at 91 the next morning. You want to, if it goes from 80 to 90, you want to pull back to like 85. Then let it go up and break out through that high the day before. Then you're going to be safe. But what people are doing is they buy a stock at 80, it goes to 90, and the next morning, the minute market opens at 9:30, bam, they jump right in. They jump. More people lose money on the opening than anywhere else. So these are the same stocks that everybody's buying right now, except institutions. Institutions aren't buying them. They're speculating, but they're not buying and holding them. They're in the bond business. They're really buying a lot of bonds because they see what's coming. So again, all these AI stocks is keeping this whole economy alive is all just, everything's just fake. I mean, think about the leaders. You got NVIDIA, Meta, and AMD's up 550%. Then you got the middle group, ABGO, Amazon, and Google up 300%. 12 stocks. This is insane. And then you got the machine makers up 200%. So why are you in any other stock? So you got to stay with these same stocks, and then you got to learn how to sell short. But the sad part is that when in 2008, once they got the taste of QE and they were guaranteed, think what they did. In 2008, started really 2009, but under Obama and Bernanke, they said, look, let's just, every time the market pulls back 4 or 5%, guarantee everybody, go in and buy. And we'll push that market up. And we'll do it by buying bonds. And when the yields go down, you come in and buy because it's going to jack this market right up. That's what they did for 14 years. If you missed that 14 years, you missed owning your own gold mine. Think about it. For 14 years, you could not lose money if you were in those same stocks because they were guaranteed. Whenever do we have a stock market, for God's sakes, that would guarantee you on every pullback? Now what they're doing is now they're telling you buy on dips. You can't buy on dips now. What are you, nuts? There's no QE. Every time a stock market pulled back in the last 14 years, you had a guarantee. The Fed would come in, buy treasuries, push yields down, stocks would go up. Now they're telling you to buy on dips, and we don't have QE. You're going to get slaughtered. Play those other couple clips we had.
Fundamentals aren't bad. The U.S. economy is doing okay, and I don't see excesses in the economy which presage a recession.
I never heard of anything so stupid as that. I mean, what a statement that is. I mean, that just makes absolutely no sense what he just said. I mean, everybody's going crazy with AI. And Wall Street is getting worse and worse. I mean, growth is coming from earnings? No, it's not. No, it's not. It's not driven by, anybody who says that this market is doing well because it's driven by earnings, they're totally wrong. Because earnings growth is too narrow. All the earnings are coming from tech, AI-linked mega caps, communication services, but market caps are far larger than earning gains. But this guy will say, boy, earnings are good. We got good growth there. No. So stay with those 12 stocks, learn how to go long, protect yourself, and then learn how to sell short. You catch them all the way back down. And it's going to happen at some point, believe me. In the meantime, I'll see you on the charts.
Are you nuts?